Welcome to a new video where we explore the landscape of high dividend ETFs that pay monthly. Now you might be wondering, what exactly are ETFs? Well, ETFs, or exchange-traded funds, are investment funds traded on stock exchanges. Much like individual stocks, they're designed to track the performance of specific indexes, sectors, commodities, or asset classes, offering a way to invest in a diversified portfolio without having to buy each component separately. But why are we specifically interested in high dividend ETFs? These funds are attractive to investors because they focus on companies that pay out a higher proportion of their profits as dividends. That means they can provide a steady income stream, which can be particularly valuable in uncertain market conditions. They can offer a balance of growth and income, which can be an appealing combination for many investors. Over the course of this video, we'll be taking a closer look at 6 high-dividend ETFs that pay out on a monthly basis. We'll delve into the specifics of each one, discussing their performance, their holdings, and their potential benefits and drawbacks. First up, we'll examine the SPHD, or the Invesco S&P 500 High-Dividend Low-Volatility ETF. This fund focuses on the 50 highest dividend-yielding securities in the S&P 500 with the lowest volatility. Next, we'll turn our attention to the FPE, or the First Trust Preferred Securities and Income ETF. This fund seeks to provide investors with a high level of income and capital appreciation. We'll then move on to the TLT, or the iShares 20-plus Year Treasury Bond ETF, which offers exposure to long-term U.S. Treasury bonds. Our fourth ETF is the JEPQ, or the Nuveen Equity Premium Opportunity Fund, followed by the BIL, or the SPDR Bloomberg Barclays 1, 3-month T-bill ETF. And finally, we'll wrap up with the ISTB, or the iShares Core 1, 5-year USD bond ETF, which aims to track the investment results of an index composed of US dollar-denominated bonds. Stay tuned as we dive deep into each of these high-dividend ETFs. There's a wealth of information to uncover, and we're excited to guide you through it. Hello, viewers. If you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Our first stop is SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. Now, let's delve into the depths of this investment vehicle. SPHD is an ETF, or exchange-traded fund, that tracks the performance of 50 of the S&P 500's highest dividend-yielding stocks. But it's not just any high-dividend ETF, it's a low-volatility ETF as well. This means it specifically targets companies that have a lower-than-average fluctuation in their price. So, it's like a double whammy, right? High dividends and low volatility. That's a combination that can offer some stability in a turbulent market. The Invesco S&P 500 High-Dividend Low-Volatility ETF has been on the scene since October 2012. Over its lifespan, it has demonstrated a consistent performance, with a focus on delivering high dividend yields to its investors. It's like a reliable workhorse, steadily plowing through the financial fields come rain or shine. Now let's talk about its holdings. The fund's portfolio is diversified across several sectors, with a significant representation from real estate, financials, utilities, and consumer staples companies. This diversity is a strength, as it spreads the risk and potential for loss across different industries. Some of its top holdings include well-known companies like IBM and AT&T. But why is it considered a high-dividend ETF? Well, it's all about the yield. SPHD has a history of providing a higher yield compared to the broader S&P 500. It seeks out those companies within the S&P 500 that not only pay substantial dividends, but also have a track record of stability. So it's not just chasing high dividends, it's also considering the steadiness of the companies paying those dividends. But remember, while dividends are a great way to generate income, they're not the be-all and end-all. It's also important to consider the total return, which includes both the income received from dividends and the capital appreciation of the investment. SPHD, with its focus on high dividends and low volatility, can be a valuable addition to an investment portfolio, especially for those who are looking for a steady income stream and a bit of a buffer against market volatility. So, there you have it, a snapshot of the Invesco S&P 500 High Dividend Low Volatility ETF. It's a fund that offers a blend of high dividend yields and lower volatility, all wrapped up in a diversified portfolio of S&P 500 companies. It's a fund that has weathered the ups and downs of the market while consistently delivering on its promise of high dividends. Indeed, SPHD presents a compelling case for those seeking high monthly dividends. Next on the list is FPE, the First Trust Preferred Securities and Income ETF. This is not just an ordinary fund, it's a trailblazer among high-dividend ETFs that pay monthly. It's a star player in the world of exchange-traded funds, and we're about to delve into why. FPE is part of First Trust, an organization known for its innovative and research-driven approach to ETFs. This particular fund focuses on preferred securities and other income-producing securities. Now, for those who may not know, preferred securities are a type of investment that blends features of stocks and bonds. They typically pay dividends, which can be a significant source of income for investors. So why does FPE shine in the realm of high-dividend ETFs? Well, it's primarily because of its impressive performance and its strategic holdings. Let's break these down a bit further. When we talk about performance, FPE has a strong track record. It's consistently delivered solid returns over the years, which is a testament to its robust strategy and effective management. It's not just about the numbers, though, it's about the fund's resilience. In a volatile market, FPE has demonstrated its ability to weather the storm and come out on top. Now, let's move on to holdings. FPE holds a diverse portfolio of preferred securities and other income-producing securities. This includes everything from traditional preferred shares to convertible securities and even some corporate bonds. It's this diversity that helps to spread risk and potentially enhance returns. And remember, these are all income-producing securities, which means they're designed to pay out dividends. That's music to the ears of any investor looking for consistent income. But there's more to FPE than just performance and holdings. It's also about strategy. The fund uses a credit research approach to identify promising securities. It's not just about picking the highest-yielding investments, but about finding those with the potential for sustainable income and capital appreciation. This strategy has proven to be effective, and it's one of the reasons why FPE stands out among other high-dividend ETFs. So, if you're an investor searching for consistent monthly dividends, why should you consider FPE? Well, it's simple. FPE offers a unique blend of robust performance, diverse holdings, and a strategic approach to investment. It's not just about the potential for high dividends, but about the prospect of sustainable income and capital appreciation. But remember, as with any investment, it's important to do your own research and consider your personal financial situation before making a decision. Investing is not just about following trends, it's about making informed decisions that align with your financial goals and risk tolerance. For investors searching for consistent monthly dividends, FPE surely stands out. It's a shining star among high-dividend ETFs, and it's worth considering if you're on the hunt for monthly income. Moving on, let's delve into TLT, the iShares 20-plus Year Treasury Bond ETF. This ETF is quite the standout in the world of high-dividend funds, and for a good reason. Picture this, an ETF that combines the reliable stability of U.S. Treasury bonds with the attractiveness of high-dividend yields. Sounds intriguing, right? That's precisely what TLT offers. Let's get a bit more into the specifics. TLT is an exchange-traded fund managed by BlackRock, one of the world's largest asset managers. This ETF primarily invests in U.S. Treasury bonds with maturities of 20 years or more. Now, what does this mean for investors? In simple terms, it means that TLT provides exposure to long-term U.S. Treasury bonds, and these bonds are known for their stability and reliability. But let's not forget about the dividends. After all, that's why we're here, right? TLT has a history of delivering attractive dividend yields. These dividends are typically paid out on a monthly basis, which can be a significant plus for investors looking for consistent income streams. And while past performance is no guarantee of future results, TLT's track record certainly speaks volumes about its potential. So, what makes TLT a high-dividend ETF? Well, it's all about the fund's holdings. TLT holds U.S. Treasury bonds, which are essentially loans made to the U.S. government. These bonds pay interest to the bondholder, and that interest is then passed on to TLT investors in the form of dividends. The longer the maturity of the bond, the higher the interest rate, and consequently, the higher the potential dividend yield. And since TLT focuses on bonds with maturities of 20 years or more, it naturally tends to have higher dividend yields compared to shorter-term bond ETFs. But it's not just about the dividends. TLT also offers the benefit of stability. U.S. Treasury bonds are considered one of the safest investments out there, as they're backed by the full faith and credit of the U.S. government. This makes TLT a potentially appealing option for investors looking for a blend of income and stability. To sum it up, TLT is a unique player in the high-dividend ETF space. It provides exposure to long-term U.S. Treasury bonds, which are known for their stability and reliability. At the same time, it offers attractive dividend yields, making it a potentially appealing option for income-focused investors. And while investing always involves risks, TLT's blend of income and stability could make it a worthy addition to a diversified investment portfolio. TLT offers a unique blend of long-term stability and attractive dividends. And with that, we wrap up our deep dive into TLT, the iShares 20-plus Year Treasury Bond ETF. Stay tuned as we continue our journey through the world of high-dividend ETFs. Next up is JEPQ, the Nuveen Equity Premium Opportunity Fund. This fund is an investment company that seeks to provide investors with a high level of current income and capital appreciation. JEPQ achieves this by investing in a diversified portfolio of equity securities and writing call options on a portion of the equity securities held in the portfolio. Let's delve a little deeper into this fund. JEPQ, managed by Nuveen, primarily invests in common stocks of companies that are believed to be undervalued and have a high potential for growth. The fund's portfolio managers also write call options on a portion of these equity securities. This strategy provides the fund with additional income from the premiums received from selling the options, and this income is distributed to shareholders in the form of dividends. Now, let's talk about the performance of JEPQ. Over the years, the fund has demonstrated a strong track record of performance. Despite the ups and downs of the market, the fund has been able to maintain its objective of providing a high level of income and capital appreciation to its investors. This is a testament to the fund's robust investment strategy and the expertise of its portfolio managers. Let's take a closer look at the holdings of JEPQ. The fund has a diversified portfolio of equity securities, which means it invests in a wide variety of sectors and industries. This diversification helps to reduce the risk associated with investing in a single sector or industry. Some of the top sectors in JEPQ's portfolio include information technology, healthcare, and financials. The fund's holdings also include a mix of large-cap, mid-cap, and small-cap stocks, providing further diversification and potential for growth. But why is JEPQ considered a high-dividend ETF? The answer lies in the fund's strategy of writing call options on a portion of its equity holdings. The premiums received from selling these options provide the fund with additional income, which is distributed to shareholders as dividends. This strategy, combined with the fund's focus on investing in undervalued companies with high growth potential, enables JEPQ to offer a high level of monthly dividends to its investors. In conclusion, JEPQ offers a unique investment strategy that combines the potential for capital appreciation with a high level of current income. The fund's diversified portfolio, robust investment strategy, and additional income from writing call options make it a compelling choice for investors seeking high monthly dividends. Despite the uncertainties of the market, JEPQ has demonstrated resilience and consistency in its performance. JEPQ thus emerges as a strong contender for high monthly dividends. Despite the challenges and volatility of the market, JEPQ continues to provide its investors with a high level of income and the potential for capital appreciation, making it a compelling choice for those seeking a high dividend ETF. Now let's turn to BIL, the Spider Bloomberg Barclays 3-month T-bill ETF. BIL is a unique player in our lineup of high dividend ETFs. Instead of investing in companies that pay dividends, BIL invests in short-term U.S. Treasury bills, hence the T-bill in its name. These are government securities with maturities that range from 1 to 3 months. Essentially, when you invest in BIL, you're lending money to the U.S. government for a short period of time. In return, you receive interest payments which are then distributed to investors as monthly dividends. The beauty of BIL lies in its simplicity and safety. U.S. Treasury bills are considered one of the safest investments in the world because they're backed by the full faith and credit of the U.S. government. This makes BIL an attractive option for investors looking for steady, reliable income with minimal risk. Now let's look at BIL's performance. Over the past decade, BIL has consistently delivered positive returns, albeit at a relatively modest rate. This is expected given its low-risk investment strategy. BIL's yield, or the income it generates as a percentage of its price, is also modest, typically hovering around 1%. However, what BIL lacks in yield, it makes up for in reliability and stability. BIL's holdings are straightforward. As mentioned before, it invests exclusively in short-term U.S. Treasury bills. The ETF's portfolio is regularly updated as Treasury bills mature and new ones are issued. This keeps the portfolio's average maturity within the 1 to 3 month range, aligning with BIL's investment objective. So, why is BIL considered a high dividend ETF? It's all about consistency and reliability. BIL's dividends may be modest, but they are paid out monthly and have been remarkably stable over time. This makes BIL a go-to option for investors seeking a steady stream of income, particularly those in or nearing retirement. In addition, BIL serves as a useful tool for managing cash in an investment portfolio. It offers a higher yield than a typical savings account while maintaining a similar level of risk. This makes BIL a popular choice for parking cash that's not currently invested in riskier assets. In conclusion, while BIL may not dazzle with high yields or rapid growth, it shines in its own way. It offers a steady, reliable stream of income backed by the full faith and credit of the U.S. government. It's a low-risk option that delivers consistent dividends month after month. Whether you're a retiree seeking a stable income source or an active investor looking for a safe place to park your cash, BIL has a place in your portfolio. BIL is certainly a solid choice for those seeking reliable monthly dividends. Finally, we have ISTB, the iShares Core 1, 5-year USD Bond ETF. This fund is an optimal choice for those seeking a moderate level of risk with an attractive yield. The ETF has a primary focus on U.S. bonds with maturities between 1 to 5 years, offering a balanced blend of safety and return. ISTB is part of the iShares Core series, a collection of 9 cost-effective funds designed to provide broad, diversified exposure to different aspects of the market. The ETF is managed by BlackRock, one of the world's most reputable asset management firms, which gives investors a level of confidence in the fund's management and strategy. The fund's performance has been commendable. Over the past 5 years, ISTB has delivered a steady return with low volatility. This consistent performance is primarily due to its diversified portfolio, which includes a wide range of bonds from different sectors and credit qualities. ISTB's holdings are mainly U.S. government and corporate bonds, which are considered relatively safe investments. This mix of bonds ensures a steady income stream while mitigating the risk of potential losses. The fund also includes a small portion of international bonds, providing a dash of global exposure. But what makes ISTB a high dividend ETF? Well, it's all about the yield. The ETF has a higher yield compared to many other bond ETFs in the market. This high yield is due to the fund's focus on bonds with shorter maturities, which typically offer higher interest rates. Therefore, by investing in ISTB, investors get the opportunity to earn high monthly dividends. One more thing to note about ISTB is its low expense ratio. The fund charges a minimal fee, which makes it an affordable option for those who want to keep their investment costs low. ISTB completes our list, offering yet another excellent option for high monthly dividends. This ETF combines the benefits of a diversified bond portfolio, steady returns, and high dividends, making it a compelling choice for those seeking to generate a regular income stream from their investments. So there you have it, 6 high dividend ETFs that pay monthly. We've journeyed through the stable and low volatility SPHD, the diversified and income-focused FPE, and the long-term interest rate-sensitive TLT. We've explored the equity premium opportunities offered by JEPQ, the short-term, low-risk BIL, and the medium-term investment-grade ISTB. Each of these ETFs brings unique benefits and considerations to the table. Remember, investing is not a one-size-fits-all endeavor. It's crucial to consider your own financial situation, investment goals, and risk tolerance before making any decisions. Conduct your own research, consult with financial advisors, and make informed choices. This video is just a starting point, a spark to ignite your interest in high-dividend monthly paying ETFs. The world of investing is vast and full of potential, so go forth, explore, and let your investments work for you. Don't forget to subscribe, like, and share this video with others who might find it helpful. Until next time, happy investing.